The Reserve Bank is expected to lift interest rates for the third time in as many months. An increase of half a percentage point is anticipated. That would take the official cash rate from 0.85% to 1.35%. Joining me now is Ian Verinder, the ABC's business editor, finance presenter Alicia Barry, and Eleanor Creagh, senior economist at PopTrack. Alicia, let's go to you first. How big a rate cut are we anticipating the RBA to announce today?
Well, the majority of economists are anticipating a half a percentage point increase, as you pointed in the introduction. Now, the Reserve Bank could divert from that expectation and increase interest rates by 25 basis points or even 40 to get it back to that 25 basis point increment. But look, the RBA really has no choice but to raise interest rates today. Inflation is running at a 21-year high. It's sitting at 5.1% annually, and we won't get another updated reading on inflation until the very end of this month, on the 27th of July. The expectation is that inflation is going to keep running hotter and end up at around 7% by the end of December. So the RBA is really mandated with keeping inflation between 2 and 3%. We're well outside of that band at the moment. And while it does note that most of the inflationary pressure is coming from things it can't control, like energy and agricultural commodity prices due to the Ukraine war and supply chain issues, it only has one tool, and that's interest rates. And certainly the RBA, because it was late to move on raising interest rates and was talking about the cash rate not moving until 2024, really wants to get this right because it's looking at a bit of a credibility issue.
And Ian, on that point, that has been what's taken so many consumers, I guess, by surprise and shock, is that these rate rises have come, and they've come quickly, and they're big.
They are. They're exceptionally big. Look, they used to be a lot bigger back in the 90s, but because we now have so much debt, both at not just Australia, but at a government level, but particularly a household level in Australia, we are extremely sensitive to interest rate rises. You know, back in the mid-90s, I think 94, interest rates were raised by just shy of 3% over a 6-month period, 3 percentage points. Now we're looking at much smaller rates, but it's that household debt that is the worry.
Eleanor Creagh, if we can bring you in here now, what has these rate rises meant for the uptake of mortgages?
Certainly, we have seen that the housing market has slowed since interest rates have risen. We've seen that buyer demand has moderated, auction volumes have cooled as well, and auction clearance rates have cooled. And we've seen that sales volumes have also slowed. Now, it's not surprising when we look at the situation that prospective buyers are facing at the moment. There's just a lot more uncertainty with respect to future borrowing costs. So not only is borrowing capacity being constrained and have mortgage rates already risen, but I think there's a lot of uncertainty around where borrowing costs are going to be over the next, say, 12 to 24 months, and certainly a lot more uncertainty than people had this time last year.
Alicia, if I can just ask you, what are we expecting or looking for when the RBA's statement comes out this afternoon?
Yeah, we want to see if the RBA is going to point to the fact that the interest rate increases are taking the emergency stimulus out of the economy. So language around that, because at the moment it looks like the previous statement said that the RBA is going to take further steps in the process of normalising monetary conditions in Australia over the month ahead, and this will be guided by incoming data. So we're going to be looking for words that will guide to the future of what perhaps size the interest rates will be, or just how consecutive they might be. So economists, market watchers will really be poring over that statement when it comes out in about 30 seconds.
And Ian, when Philip Lowe, the RBA governor, gave a very rare television interview, he revealed that he thinks that inflation will get to about 7% later in the year. Could it go even higher than that?
Oh, look, there's every chance that it could. I mean, you know, we've seen interest rate hikes, really strong ones through the US, New Zealand, right across the developed world, and inflation is still on the rise. So there's every chance it could grow here. Our inflation has been below interest rates elsewhere in the world.
Okay, Alicia, you have the decision.
As expected, the cash rate has come in with a 50 basis point, we like to say half a percentage point increase, taking it it from 0.85% to 1.35%. So very much in line with market expectations.
And there had been some speculation that the rise could be 40 basis points because we know that the RBA likes to work in those 1.25, 1.5% or, 25 basis points, 50 basis point rises just to have those kind of even numbers. Do you think that's going to come at some point?
Well, I'll let Ian answer that one.
There was a chance that they could have actually raised it up to 1.5% today to actually get to that even Stevens level. And they do like to operate in that band, 1%, 1.25, 1.5. And so there was some discussion that it could actually go that high today because, as Alicia mentioned earlier, the credibility problem that the Reserve Bank has, because remember all of last year it was essentially saying that rates wouldn't rise for another 3 years till 2024. And so they're now behind the eight ball on a lot of this, what's been going on in the rest of the world. And so there was a distinct possibility that they could push it up to get to that even level and to also, put the message out there that they are very serious about curbing inflation.
And to that point, perhaps they are really trying to front load, as many have been talking about, these interest rate increases, and we'll assess the inflation data when we get it at the end of this month and then take it back to those 25% basis point increments. But I'll just read you the paragraph that is really the one that everyone wants to read. And the RBA today has said today's increase in interest rates is a further step in the withdrawal of extraordinary monetary support. The resilience of the economy and higher inflation mean that this extraordinary support is no longer needed. Now that sort of mirrors the June statement. The board expects to take further steps in the process of normalising monetary conditions, and the size and timing of these future interest rate rises will be guided by the outlook for inflation and the labour market. So it really does point to the fact that the RBA will be very closely watching the upcoming data and making its decision based on that.
So for people who have mortgages, the maths has been done on this. So say, how much does your mortgage repayments go up a month as a result of this?
So for $750,000, and we do need to note, and Eleanor will be able to talk to this, that some people are still on fixed rates. But if you're looking at an average mortgage over 25 years of $750,000, an extra 50 basis points or a half a percentage point will add $205 a month. Now, that is actually taking this month and the May and June increases at around $400 or so a month. So it is quite a significant increase to the monthly payments, and that's for households to sort of absorb as they're already facing higher fuel and vegetable and fruit prices and grain, agricultural goods prices. So, yeah, the burden on consumers is going to be substantial over the next coming months.
And Eleanor Cray will bring you in there. So we kept hearing that during the pandemic, households had built up savings, and that will help cushion the blow for some of these rate rises. At what point does that stop?
Yeah, look, exactly right. So at the moment, most borrowers should be able to absorb rate rises. Households are sitting on some $240 billion in excess savings, wealth accumulated since the pandemic onset as well. So there is money there that households can draw on. Also, I would point to the fact that many borrowers are actually ahead on their mortgage. So the RBA estimates that, the typical owner-occupier borrower is around 2 years ahead on their mortgage. I think another really important factor that we have to consider is the fact that the RBA also estimate that around 40% of variable rate borrowers would actually see no increase to their repayments until the cash rate is above 2%. That's because many people actually kept their repayments at the same level when interest rates declined. So they've used this period of record low interest rates to pay down debt quicker. And then you have that proportion of borrowers on fixed rates. So we know that fixed rates fell to or plunged to record lows throughout the pandemic, and around 40% of borrowers are on fixed rates. Now, most of those fixed rates don't expire until sometime next year. So again, you're looking at a picture where probably over half of borrowers don't actually face any impact at all until next year when fixed rates start rolling, or until the cash rate is actually above 2%. But that's not to say that people aren't facing a spending squeeze at the moment. Certainly, as Alicia pointed out, cost of living pressures have risen, inflation has risen, and real wages or real income growth is actually in negative territory at the moment. So certainly that is going to be squeezing households, but we do think that for now, most borrowers should be able to absorb rate rises. Another important factor there is the fact that people are sitting on substantial home equity as well, which should also provide a buffer and keep people from being too stressed.
For Ian, I wanted to bring you in and ask you about people who are saving. How quickly will these rate rises be passed on to savers?
Probably pretty slowly, but just on Eleanor's point there, and there's been a lot spoken and written about all of this. The problem with talking about buffers and savings and equity in home is that it's all concentrated in the older your demographic, the more buffer you have, the more equity you have in your home, the more savings you're likely to have. It's the first home buyers who got in last year who are the ones who are in quite a bit of, looking at quite a lot of angst into the future here, and while a lot of them are on fixed rates and they probably don't run off for another year or two, they're looking at huge increases in their repayments once those fixed rates roll off. So, the buffers are not evenly distributed. So we're talking about averages, and it's all very convenient to talk about averages like that. But if you look at the way the money is actually divvied up, it's older people, like my age, really, where all the money's concentrated. And the younger you are, and the more recently you've gotten into the housing market, the more extreme the pain is going to be.
So, Eleanor, can you pick up on that point? What about people who are young first home buyers who may be over leveraged? Are they experiencing mortgage stress yet?
Certainly, the risks would be centred around those with new mortgages who potentially stretch themselves, expecting income gains, haven't had the, time to build up those buffers. And again, that would be particularly if life circumstances were to take a negative turn, unemployment or the like. And that's where it's also quite important to factor in the current economic situation. So we know that unemployment is the lowest it's been since the 70s. The labour market is tight. And for most people, there's a degree of job security and confidence at the moment. And although wages or stronger wages growth is yet to materialise, hopefully at some point this year, we do see that strengthening in incomes that should be able to offset some of the impact.
And Alicia, you were talking earlier about the inflation figures coming out later this month. Are they likely to tell us where the inflationary pressure is coming from? Because previously we were told that it was coming from international factors, but now local demand is also driving inflation.
Yeah, it will give us a bit of a breakdown of where the inflation is coming from. It will talk about transport, it will talk about fruit and vegetable prices, it will talk about education, consumer, various things. I mean, the CPI, the Consumer Price Index, takes into account a basket of goods and services that consumers typically spend on, and it benchmarks them against previous reads. So that basket changes constantly, but yes, it will definitely tell us or give us a relative indication of where those price pressures are coming from. But I will note that in the RBA statement today, Philip Lowe has said that although recent spending data has been positive, household budgets are under pressure from higher prices and higher interest rates. And look, the household sector is something that's going to be, or the consumer sector is something that's going to be very closely watched by the RBA, because even though we have a tight labour market which points to a strong economy, it will come down to whether or not households can weather these higher interest rates in the face of rising prices for a number of goods that the RBA has no control over. So how high interest rates go is a big question. The market today has been pricing an interest rate of around 3.5% by the middle of next year. Economists aren't that bullish, if you like. They're not expecting that level, more of a 2.5% or just above. But certainly how high interest rates go is really going to have an effect as to how well the economy withstands this and whether we start talking about the R word being recession.
Yeah, and I want to come to that in a moment. But before that, Ian Verinder, what sort of interest rate trajectory are we on? There are some economists and experts that are saying we could see the steepest RBA hike since the recession in the 1990s.
Yeah, look, I think that's absolutely right. We've had, but bear in mind, where have we come from? 0.1%. And you can't sit on essentially 0% interest rates, free money forever. And so at some point we were going to have to see interest rates rise. I guess where we've been taken by surprise is the speed at which they're being hiked at the moment. And that's because of this emergency situation that's arisen because of the speed in the level of price rises. And it's interesting to note, though, that with price rises, there's two things that can push prices higher, either reduced supplies or increased demand. And interest rate hikes are really designed to curb demand. And what we've got at the moment is reduced supply that's essentially driving inflation at the moment. And we're using a tool that decreases demand. So it's not really the most effective tool to try and rein in this kind of inflation, but that's the only weapon they've got.
And to pick up on Alicia's point about recession, this is something that is now being talked about as a possibility in Australia, when just a couple of months ago, most economists and experts were saying that that was not looking likely. What are we talking about? 18 months, 2 years?
I don't know, and I don't think anybody knows the answer to that. But look, recession is a real possibility because every time central banks globally have tried to really, put the brake on inflation, most of the times we've ended up in a recession. The most recent time, of course, was the 1980s when, inflation really got out of control and they just slammed interest rates right through. That was when we had interest rates up around about 17.5% as the official rate. And then you had mortgages on levels well above that. So, and what that resulted in was a recession that really the impact of it lasted for more than a decade in terms of unemployment. So, we don't know where we're going at the moment, but there is a very strong chance of recession, and money markets are already starting to price that in. And so, you would start asking how high will rates go? Well, 3 weeks ago, the money markets were talking about much higher rates than they are now because the prospect, that spectre of recession, is starting to rein everybody's ambitions or targets back to a more realistic level.
Okay, before we wrap up, Alicia, do you just want to give us a quick wrap on what the RBA's decision was for people who may have just tuned in?
So the RBA has, as expected, lifted interest rates by another 0.5 percentage point. So that's the third interest rate increase in a row. And it's taken the official cash rate to 1.35%. The RBA has indicated that there are going to be more interest rate increases to come, and that they're going to be dependent likely on the data that's presented. It pointed to inflation and unemployment, which we will get at the end of this month, that key inflation read. And it's worth noting that since the decision from the RBA came out, the market has barely moved. So it was really priced in, very much in line with expectations. And the Australian dollar, before we started talking, was sitting at 68.77 US cents. It's now fallen just slightly to 68.61. So perhaps those in the markets were expecting a slightly stronger increase from the RBA. But one thing is clear, the direction of interest rates is certainly moving up for now.
Okay, Alicia Barry, Ian Verinder and Eleanor Creagh joining us from Sydney. Thank you so much.